If you think the SpaceX IPO is a once-in-a-lifetime investment opportunity, stop for a moment. Because the most dangerous thing in a major IPO is not always a bad company. Sometimes the real danger is a company so famous, a story so powerful, and retail investors so excited that they rush to buy on day one without looking at the structure behind the deal. SpaceX has rockets. SpaceX has Starlink. SpaceX has Elon Musk. And because of that, many people will believe that buying SpaceX stock means buying a piece of the future. But there is one big problem. The IPO day may not be the beginning of the opportunity. It may be the moment the countdown starts. And somewhere between day 70 and day 180, the real game begins. The first thing we need to make clear is this. This is not a video about SpaceX being a bad company. In fact, it is the opposite. SpaceX may be one of the most impressive companies in the world today. It launches rockets. It is building Starlink. It has deep defense contracts. And it is standing in a position that very few businesses on Earth can reach. But in investing, there is one truth that many people forget. A great company does not automatically become a great stock at any price. You can love the product. You can believe in the future. You can admire Elon Musk. But if you buy at a price that is already too high, right when insiders are getting closer to their first chance to sell, the person carrying the biggest risk may not be them. It may be you. Because the real question in an IPO is not just whether the company is good or bad. The real question is who is selling, who is buying, and who this deal was designed to benefit. The second thing you have to understand is valuation. Because before we even talk about lockups, insider selling, or the calendar after the IPO, we have to ask one simple question. What price are people being asked to pay? In this analysis, SpaceX is going public at an extremely large valuation, around $1.75 trillion. And last year's revenue was mentioned at roughly $18.7 billion. So in simple terms, investors are paying about $94 of market value for every $1 of revenue. That is not cheap. That is not even normal. That is a price that already assumes an enormous future has arrived before it has fully happened. And this is where many retail investors get trapped. They look at the company and say, SpaceX is amazing. But the market is not asking you whether SpaceX is amazing. The market is asking you whether SpaceX is amazing enough to justify a price that is already priced in years of near-perfect growth. Because when a stock is valued this high, the company does not just need to do well, it needs to do almost everything right. Revenue needs to keep growing. Margins need to improve. Starlink needs to keep expanding. Rocket launches need to keep scaling. Government contracts need to keep flowing. And investors need to keep believing that the future will be even bigger than the price already suggests. That is the risk. If growth is slower than expected, the stock can fall. If profits do not arrive as quickly as expected, the stock can fall. If investors simply begin to question whether the valuation is too expensive, the stock can fall. And that is why buying an IPO at an extreme valuation is so dangerous. You are not just buying the company, you are buying the dream. And in this case, that dream may already be priced like it came true. The third thing you need to understand is the supply of shares on IPO day. Because when most retail investors hear that a company is going public, they assume the entire company is suddenly available to buy. But that is not how an IPO works. When a company goes public, only a small portion of its shares usually starts trading on day one. In this case, only about 5% of SpaceX shares are available in the public market at the beginning. The other 95% is still held by the people who got there first. The founders, the employees, the venture funds, the early investors, and the insiders. So, what happens when one of the most famous companies in the world goes public, but only a tiny slice of the stock is actually available to trade? You get a very dangerous effect. Supply is small. Demand is massive. Everyone wants to buy SpaceX. Everyone is afraid of missing out. Everyone thinks that if they do not buy today, tomorrow may be too late. And when a huge crowd of buyers starts chasing a very limited number of shares, the price can rise extremely fast. But that rise does not always mean the stock is truly worth that much. Sometimes, it only means the market is temporarily starved for supply. That is the part many people miss. A day one IPO pop can look like proof that the company is unstoppable, but it may simply be proof that too many people are fighting over too few shares. In other words, IPO day can feel like a stage with bright lights, loud headlines, and everyone staring at the same exciting performance. But the most important part of the show is not happening on the stage. It is happening behind the curtain. Because while retail investors are watching the price go up, insiders are watching the calendar. And the real question is not just how high the stock can run on day one. The real question is, what happens when the other 95% starts getting closer to the exit door? Now we get to the most important part of the entire story, the lockup schedule. Because after an IPO, insiders are usually not allowed to sell their shares immediately. That includes founders, employees, early investors, venture funds, and other people who own the company long before the public ever got a chance to buy. The reason is simple. If all of those insiders could sell on day one, the market could be flooded with shares immediately, and the price could collapse before the IPO story even has time to breathe. So instead, those shares are locked. But here is the part many retail investors misunderstand. Locked shares do not disappear. They are not gone. They are not harmless. They are simply waiting for the day they are allowed to come back into the market. And in this case, the lockup schedule is not just one simple 180-day wall. It is broken into several different doors. Day 70, one portion unlocks. Day 90, another portion unlocks. Day 105, more shares become available. Day 120, another window opens. Day 135, another group gets closer to selling. Then there are additional unlocks tied to earnings reports. And finally, day 180 arrives. This means that during the first 6 months after the IPO, the market may have to absorb wave after wave of new insider shares. Not all at once, but again and again. And that is exactly what most retail investors do not track. They watch the first day price, they watch the headlines, they watch Elon Musk, they watch the rocket launches, they watch the excitement, but insiders are watching something else. They are watching the calendar. They know when their shares unlock. They know when their first exit window opens. They know when the market might be full of excited buyers willing to pay a premium. And if the stock price is being pushed higher by hype, scarcity, and fear of missing out, that can become the perfect moment for early holders to turn paper gains into real cash. That is the uncomfortable truth of many IPOs. Retail buyers see the dream. Insiders see liquidity. Retail buyers see the future. Insiders see an exit window. And the person who does not understand the calendar may end up buying right when someone else is finally allowed to sell. The next point is even more dangerous. Because in this IPO structure, if the stock rises too much after the IPO, some insider shares may not have to wait for the normal unlock schedule. They can unlock early. And this is where the day one excitement starts to become dangerous. In this structure, if the stock trades about 30% above its IPO price for a certain number of days before the first earnings report, another portion of insider shares can become eligible for sale earlier than expected. Think about what that means. For retail investors, a stock jumping after IPO feels like confirmation. They look at the chart and think, I was right. They see the price rising and think, the market agrees. They see other people rushing in and think, if I do not buy now, I may miss the move forever. But insiders may see the exact same price move in a completely different way. Retail investors see a rally. Insiders may see a trigger. Retail investors see momentum. Insiders may see an opening door. Because the higher the stock climbs, the closer it may get to activating the condition that releases more insider supply into the market. That is the strange part of this setup. The thing the crowd is celebrating could be the same thing that creates the next wave of risk. If more people FOMO into the stock, the price can rise faster. If the price rises fast enough, the early unlock condition becomes more likely. And if that condition is triggered, more insider shares can enter the market sooner. So the rally does not just reward the people buying, it may also reward the people who have been waiting years for a chance to sell. That is why the first few weeks after a major IPO can be so misleading. The chart can look strong. The headlines can sound exciting. The crowd can feel confident. But underneath the surface, the structure of the deal may be quietly changing. More buying pressure can push the price up. A higher price can activate early unlocks. Early unlocks can bring new supply, and new supply can change the entire balance between buyers and sellers. That is why IPO day is not always the beginning of opportunity. Sometimes, it is the beginning of the trap, because the same price movement that makes retail investors feel safe may be the movement that gives insiders one more door to exit. The biggest lesson here is not that you should never buy SpaceX, and it is not that every IPO is bad. That is too simple. The real lesson is this: never buy an IPO only because the name is famous. Because in an IPO, the story is usually the easiest part to understand. The product is exciting, the founder is everywhere, the future sounds massive, the headlines feel urgent, and the crowd makes it feel like waiting is a mistake. But serious investors do not only look at the story, they look at the structure of the deal. They ask what the stock is being valued at. They ask how much of the company is actually trading on day one. They ask how many shares are still locked up. They ask when insiders are allowed to sell. They ask whether there is an early unlock clause. They ask whether index funds could create forced buying. And they ask whether the company has reported real public earnings yet, or whether investors are still buying mostly on belief. These questions may sound boring. They do not make exciting headlines. They do not feel as powerful as rockets, satellites, or a famous founder. But these are the questions that separate patient investors from emotional buyers. Because emotional buyers look at the price and ask, is it going up? Patient investors look at the deal and ask, who benefits if I buy right now? The media will talk about Elon Musk. Social media will talk about the stock popping. The crowd will talk about a once-in-a-lifetime opportunity. But the prospectus tells you something quieter. The lockup schedule tells you something quieter. The earnings reports tell you something quieter. And usually the quiet information is where the real game is hiding. Because the market does not reward the person who gets excited first. It rewards the person who understands what is actually happening beneath the excitement. So, before chasing any IPO, ask the questions most people skip. Read the mechanics. Follow the calendar. Watch the unlocks. Wait for the real numbers, because the name on the stock may be famous. But the structure of the deal is what tells you who is really being protected, who is being offered an exit, and who may be left holding the risk. SpaceX may still be a great company, maybe even one of the greatest companies of this generation. But a great company can still become a bad investment if you buy it at the wrong time, at the wrong price, and on the wrong side of the deal. That is the part many investors do not want to hear. Because when the story is exciting, patience feels like weakness. When the stock is moving, waiting feels like missing out. And when everyone is talking about the future, asking basic questions can make you feel like you are being too cautious. But smart investors do not need to buy on day one just to prove they understand the future. Sometimes, the smartest decision is to wait. Wait for the market to become less emotional. Wait for the first wave of insiders to pass through their exit windows. Wait for the lockup schedule to reveal how much supply the market can actually absorb. Wait for the company to report real numbers as a public business. And only then decide whether the price still makes sense. Because in investing, the number on the screen is loud. It moves every second. It gets headlines. It creates excitement. It makes people feel rich when it goes up and afraid when it goes down. But the lockup calendar is quieter. It does not trend on social media. It does not look exciting on a chart. But it quietly tells you something much more important. Who is allowed to sell, when they are allowed to sell, and who may be buying from them when that window opens. That is why the real risk in an IPO is not always visible on day one. It is often hidden in the structure, hidden in the calendar, hidden in the timing, hidden in the difference between the people who got in early and the people who are being invited to buy last. So if you do not know which side of the deal you are sitting on, be careful. Because you may think you are buying the future. You may think you are buying innovation. You may think you are buying the next great company before everyone else. But in reality, you may simply be buying the dream that someone else has been waiting years to sell.